When most people first begin learning about investing, they usually hear the same three terms over and over: stocks, bonds, and ETFs. At first, they can sound confusing, especially because all three involve putting money into financial markets. But they work very differently. Let's start with stocks. A stock represents partial ownership in a company. When someone buys stock in a company like Apple or Microsoft, they own a small share of that business. Public companies sell shares to investors through stock exchanges. The price of a stock changes based on supply and demand in the market. If investors believe a company is performing well or may grow in the future, demand for the stock can increase. If confidence drops, demand can decrease. Some companies also pay shareholders part of their profits through dividends. Although not all companies do this. Stocks are generally considered growth-oriented investments because historically the stock market has produced higher long-term average returns. However, stock prices can fluctuate significantly over short periods of time. Now let's look at bonds. A bond is different because it does not represent ownership. A bond is a type of loan. When governments, municipalities, or companies want to raise money, they can issue bonds. Investors who purchase those bonds are lending money to the issuer. In return, the issuer typically agrees to pay interest at scheduled intervals and repay the original amount borrowed at maturity. For example, U.S. Treasury bonds are issued by the federal government, while corporations can issue corporate bonds. Bond prices can also change over time, especially when interest rates change. In general, bonds have historically experienced lower volatility than stocks, although risk levels vary depending on the issuer. Some bonds are low risk, while others are substantial. Now let's explain ETFs. ETF stands for Exchange Traded Fund. An ETF is an investment fund that trades on an exchange, similar to a stock. An ETF can hold many assets inside a single fund. Those assets may include stocks, bonds, commodities, or other securities. For example, one ETF may track the S&P 500 index. Another may focus on government bonds. Another may hold international stocks. Because ETFs often contain many investments, they can provide diversification within a single purchase. Diversification means spreading investments across multiple assets instead of relying on one individual company. ETFs became popular because they combine diversification with trading throughout the day. So in simple terms, stocks represent ownership in a company. Bonds represent loans made to governments or organizations. ETFs are funds that can hold many investments together inside one structure. These investment types are often used for different goals. Stocks are commonly associated with long-term growth. Bonds are for income and lower volatility compared to stocks. ETFs are used to gain diversified exposure to groups of investments. And understanding these differences is a foundational step in learning how